there's a divergence in terms of growth, really, between US and other major economies.
Yes.
As we talked earlier, European growth is just around zero, fluctuating around zero, while we have something around 2.5. And that is likely to stay. The reason is, again, we have high levels of wealth.
Yeah.
And that is supporting consumption, while Eurozone doesn't, or UK doesn't. So there's a divergence in growth. On inflation, more or less everyone experienced a surge in inflation, supply chain issues, food and energy issues, and they have been coming down. Almost lockstep, maybe a little later in Europe, in various countries, but the disinflationary forces has come from the normalization of supply chains, which resulted in decline in goods inflation, and any shocks related to food and energy mostly dissipated. But services inflation, even in Europe, is pretty sticky. Still, there's some disinflationary forces in Europe as well, but will services inflation come down enough? I don't know. Their labor market is tight as well. Despite growth fluctuating around zero, we haven't seen any negative impact on labor market. But because of this growth differential, and Europe is still more vulnerable to shocks, they will be cutting.
They will be cutting.
But will they cut as much as the market expects, or will they start worrying about the stickiness in services inflation? We don't know. So
that's the risk.
Yes, that is the risk.
And it wasn't like, if you going back to the Fed pivot, you think about inflation wasn't at their target. It was just coming down in a way that they felt confident that they were going to get to their target. And they shifted to growth as anticipatory. Our policy is now going to protect growth. And so growth became the focus for everybody. Yeah. And some of it kind of makes sense. Like the tool sets that they have today, given where debt is, like usually when you get into a recession, the Fed can help and fiscal policy can help. But given where the balance sheets of the governments are, it's just less likely or less powerful of help where we are fiscally. And so I think the central bankers may be becoming more risk managers on the growth side than they were inflation, because they always think that they can handle inflation, except for that narrative got tripped up over the last couple months because of the things that we mentioned earlier about, hey, consumption's really high and the consumer's still doing pretty good, and you can see it in various forms of inflation. And so now I think the markets are wrestling with this. The Fed's focus is turning back to inflation. You can hear it now in all the narrative from all the Fed governors. Yes, this is why we need to be slower than we thought we would be, or just questions around should we be cutting. But it is it's an interesting dynamic how their policy had geared toward cutting rates. And it's not that growth itself, or we were into a recession. It's just that they didn't want a recession, and everyone wanted the soft landings in the way that we're just harder and harder to see where how these are going to play out over the next couple months. But
sure.